Good day everyone, welcome to this short educational video about how to read candlesticks, which are used a lot in trading, Forex, options, stocks, a lot of things. So let's get right into it. This is going to be a short explanation and a short education because it is not that difficult, but you need to know it. So candlesticks. Why use candlesticks? Because you have certain types of charts. Of course, you have the line chart, which is very easy to read. You just see a line that goes up and down or goes sideways. You also have more difficult chart types, like a Renko chart, which measures the amount of movement and not the time. So why use candlestick charts? And there are a lot of reasons for it, but the main reason is that it gives more definition to the chart. Candlesticks give a really good definition of what price did within a certain time frame. You can also switch time frames, which is very handy, and it is also kind of self-fulfilling because certain technical indicators work because they are based on candlesticks, and because they are based on candlesticks and people use them because people use them, they might work in certain strategies and in certain systems. So now let's go on to how to read them. I have two candlesticks here. On the left, a bullish candlestick, which is in most charts green, or it is hollow or white, and on the right a bearish candlestick, which on most charts is black and red. You can also change the colors of the candlesticks to make it more fancy or more to your liking, but that's up to you. So right here, I will show it with my mouse. There are two parts to a candlestick. I will show it with the green one and with the red one because they are modern, they're mostly used right now. You have the wicks and you have the body. So basically what it means is right here at the bottom of the body is where it opens and where it closes. So it opened here, and in the meanwhile it went up because it's green, and it closed there. But then you also have the wicks, and wicks are places where the price has been. So what was actually possible is that price opened here, went down first up until the low, and then went up until the high and retraced a little bit to close here. What is also possible is that it opened here, went up a little, went down to the low, went up to the high and to the close. So basically a lot of things can happen with the price within this one candlestick, but the one thing we know for sure is that it opened here, closed here, and within this time frame that the candle is based on, it went up here and it went down there. The same goes for the bearish candlestick, but then vice versa. So it opened here, price went up maybe, went to the high, then went down, perhaps went up again, down, up, to the low, to reach a low, and then closed. So what I did there with down, up is to show that a lot of things can actually happen within one candle. Then right here I chose a small chart to just do it again, but then with a real chart, because most charts you just see this, you don't see one candlestick. And also a line chart for comparison for if you forgot. This is the most simple way. There are just points along the line and you can see it. But here you can see the candlesticks. So basically other candlesticks were here, price opened here, it reached a low here and it reached the high there, so quite long wicks. The price moved a lot, but it closed just above. Then most of the time the candles they align, so the close of one is the open of another. There are always small margins, like you see. It's not perfect, but that can happen. Small gaps can happen, bigger gaps can happen as well, but I will make another video on that very soon. So here you can see that price opened here, closed here, perhaps it opened here, it went down first, and then it went up a lot, and then it retraced a little, came here, and it opened right here because it is a red candle, so price went down, so it opened up here. Well, it closed down here. That is called a gap, which can happen. Certain exchanges have low liquidity, and then it just happens that the price shoots up. Also at market openings, market closes, very short time frames, it happens a lot. And then you can see here, it closed here, opened right here. Perhaps it went up all the way to this high of the wick, then went down to the low, and then went up again to the close here. I think you get the memo. There are also a lot of patterns in candlesticks. For example, here you have a doji, which has a very small body and longer wicks, and those candlesticks can actually tell you a story about what buyers and sellers are doing, and it can give you an expectation of what the price might do. Those are called candlestick patterns. You have patterns with one. This is an inverse hammer. You have candlesticks where you need two candlesticks, or where you need three, and those give indications of is the price going up, going down, or is it consolidating. But again, on that I will make a video as well, but this is supposed to be a short video about candlesticks, so now I hope you know how to read candlesticks.